Hello, I'm Katrina Scott, Chief Investment Officer of Mariner Wealth Advisors, and I'm joined by my colleague, Jeff Krumpelman, our Chief Investment Strategist. Our goal for today is to update you on our current thoughts regarding the markets and the impact that COVID-19 continues to have on our economy and our daily lives. Before we talk about current thoughts on the market, we wanted to address a frequent topic that has been coming up in conversations lately regarding what clients should be doing to weather this volatility. The short answer is that unless something has changed with your goals and objectives, likely the answer is to stay the course. When going through our planning process with clients, one of the most important aspects of implementing their plan is setting the appropriate asset allocation targets that are in alignment with their risk tolerance and financial goals. This means selecting the mix of assets such as stocks, bonds, and cash that create a diversified portfolio that is meant to withstand corrections in the stock market over the long term and even during corrections of the magnitude we are seeing right now. History has shown that we can do more damage to portfolios during periods of panic and fear by making quick decisions to either make a shift to that long-term asset allocation plan or to bail from it entirely out of the fear of the unknown. By looking at this history, we know that staying invested over the long term leads to higher portfolio returns than trying to time the market to avoid declines such as what we have seen recently. These types of markets will create opportunities such as rebalancing and tax loss harvesting, but we must be mindful that environments like the one we are facing now are not always the best time to race to that activity, and this must be employed selectively on a client-by-client basis depending on the specific situation. It's our job to help you stay the course and make incremental changes as needed to stay on track to the long-term plan. With that as a backdrop, I'd like to turn it over to Jeff to talk about our current views on the market movement that we are seeing today.
You know, Katrina, I couldn't agree more with your introductory comments. Adhering to the appropriate long-term allocation map with only modest adjustments over time is what leads to achieving one's long-term financial goals. And the data on trying to time the market is astonishing, and it's not good. For instance, if you set a long-term target of, say, 65% in stocks as part of your balanced mix, yet abandon that target momentarily, and for example, you miss only the 10 best days in the stock market over the last 10 years that involves more than 2,000 trading days, your return falls from the 11.3% compounded annual return over that 10-year period to only 6.6% annually in that equity component of your portfolio. If you miss only the best 20 trading days, it would have fallen from 11.3% to 3.4% annually. And if you missed only the best 40 out of that 2,000 plus trading day period, your return goes from 11.3% annually to a negative 1.4%. That is a wow. So the cost of straying from your strategic asset allocation range can be huge. That's why we set these targets and these goals from the very beginning when we work with our clients. So that, just from an overview, from that standpoint, high level, I just totally agree with what you were saying. And, I guess what I want to focus on, though, is just an update on the financial markets. And the markets are throwing some mixed signals out there, even though the overall market direction, excepting today where we've got a really strong market, and the mood has been quite negative, right now, at this time. From a technical standpoint, there are signs that the market is trying to bottom, and there are green shoots, if you will, on this technical front. And there's significant support being provided and discussed on the policy front, both fiscal and monetary policy. But the fear of spread in coronavirus in regions outside of China is at a very high level at this time. And the economic data is just now coming out that proves the second quarter in the U.S. is going to be awful. And the third quarter is likely to be challenging as well. And expectations that the fourth quarter and early 2021 will bring a significant pickup in the economy, they don't seem to be enough at present to assuage investors. It's one thing to know the bad data is around the corner. It's another to be in the midst of it, regardless of how short we expect it to be. And when you're in the middle of it, one fears it will last forever. And that's just not our view. It is human nature. And I think what we need to see to assuage this fear are two things that will help the market stabilize. One, we need to see some evidence that we can indeed bend the curve and see the uptake of new coronavirus cases in the U.S. and in pockets of Europe lessen. And, in that stage, or in that topic, there is good news on this front. In Italy, the death count has declined for 2 consecutive days, and I know that doesn't sound like a lot. We need to see the trend to continue, but new daily cases increased only 8% yesterday, and that's the lowest percentage increase since late February. Also, the death count has declined for several days. In China, we heard today there was an announcement made that travel restrictions will be lifted in Wuhan, which has been the epicenter where all this started, and those travel restrictions will be lifted on April the 8th. That's really huge news, and we do need to see more of this. But I believe that's what's really lifted the markets today before we heard that perhaps Congress is going to pass this bill and the two parties have come together on that front. And that's the second thing, though, that we do need to see. We need to see that policy will be delivered to cushion the economic pain in the belly quarters of 2020, both the second and third quarter of this year. We do think expectations have simply been too pessimistic on both of these fronts at present, and that as a result, excellent value is being created in the U.S. equity market as we speak. So we'll talk about both of those elements, what's going on in terms of trends of coronavirus, what's going on the policy front, and what we're doing to manage through this. But let's first take a look at the technicals for a minute and see what price trends and trading activity may be trying to tell us. Last week, I put out an internal note that discussed the 7 key signs that the market is in the process of forming a bottom. And those 7 signs include the following. 1, we look for evidence of extreme oversold conditions. 2, we look for apocalyptic, not just skeptical, but apocalyptic sentiment. We look for a contraction in the number of stocks making new lows. 4, we look for unmistakably strong breadth in the rallies. We're seeing some strong breadths today in the rally that's ongoing as we are speaking with you. We look for the emergence of risk-seeking leadership, so the riskier, more aggressive sectors in the market leading. We look for positive divergence from the credit markets, and by that I mean we look for high-yield spreads and even investment-grade spreads in the bond market to tighten as maybe the stock market continues to struggle a little bit. That's positive divergence where it looks like the credit markets are starting to heal. And then finally, we like to see a meaningful steepening in the yield curve. That tends to happen when you're later in the recessionary expectation part of time. And Strategist actually did a very nice report on this the other day, and we follow these same items closely as well. And there's constructive news on these 7 signal fronts. Under the first signal, it looked for extreme oversold conditions. We're there. If you look at the number of stocks that are hitting 52-week lows, the number of stocks trading below 200-day moving averages, the extreme levels in volatility, or in what's called the volatility index, the VIX, we're all at extreme levels. And at historic periods when we've hit these levels, the market has tended to turn. So signs there of bottoming. The second item, apocalyptic sentiment. Well, the percentage of investors who are bearish is at above the 50% threshold level, which puts this negative reading in the 95th percentile. It's only worse than this 5% of the time. So we're at that apocalyptic stage of negative thinking, which is a positive contrarian signal that perhaps things are oversold and overdone. In terms of the third item, the number of new lows in stocks, last Friday when we had a very weak tape, only 19% of S&P 500 names hit new lows, which is a far lower figure than you would expect on such a down day. And we've continued to see fewer lows being established the last several days. These are good signs. Under the fourth item, when we take a look at unmistakably strong breadth in rallies, it's improving, but we need a lot of distance to go here. Today, we're seeing some pretty good breadth, but we've got some wood to chop on that front. In terms of leadership, though, there are some good signs here of green shoots, and in the past several days, we've seen high beta outperform low beta, high short interest stocks outperform low interest stocks, small caps outperform large caps, low ROE stocks, low profitability stocks outperform high profitability stocks. So all that is a sign that there's increasing buying interest and there's more positivity in trading activity. So that's a good thing to see for bottoming. In terms of high yield spreads, while investment grade spreads in the bond market have tightened a little bit, high yield spreads have not. So there's some work to go in the credit markets to give us confidence. So still, this is a bottoming process from that standpoint. And on the seventh item, with regard to a meaningful steepening in the yield curve, we've actually seen that. The shape and the slope of the yield curve have improved significantly. So these are actually progressive signs on a bottoming front. We'll monitor this and continue to report as we watch this bottoming process, and I emphasize it's a process. We expect forward progress to be followed by some setbacks and retests, but perhaps we're getting to a better point in this journey, and there are some green shoots, as I've mentioned. Now, on the policy front, which we're going to get into in a short time period, if things disappoint, we've got some really good news. It looks like we've come together on fiscal policy here, but if we get any kind of setback here, the market's not going to like it. So that's why this is kind of a bottoming process. What about the coronavirus data? I think this is pretty important to hit, Katrina, for just a second. I know we all feel overwhelmed by the news that we've seen in Italy and the headlines of new cases spreading in the U.S. And we hear prognostications that just kind of sound absurd, but they're scary. Like over 1 million Americans are going to die from this, and the whole country is going to get the virus, and that 25 million Californians, or half of the population of that state, might contract it. Now, maybe we must say these kinds of things to try and scare a free people like we are in the U.S. to quarantine ourselves. It's probably not a bad shock strategy to do so. But when we look at the data, these dire forecasts don't make sense to us, and it doesn't sound like they make sense to folks like Dr. Scott Gottlieb, former head of the FDA. To wit, in China, going into this week, there had only been 81,000 total cases of coronavirus since the outbreak started, and only 3,200 or so deaths in that country, in a population of 1.4 billion people. And the new daily cases are virtually non-existent at this writing in that area. And I just mentioned that they're going to remove the travel restrictions in a couple weeks in that country. So if a country 3 times the size of the U.S. has suffered just over 3,000 deaths, why are we destined to suffer 1 million in this country? So far, we have 46,000 or so cases and about 582 deaths. And yes, it's going to ramp, but it also should be manageable given the steps that we are now taking to create social distance. California has 2,162 cases and 43 deaths to date so far, with quarantine measures now having been implemented in major parts of that most populous state for several weeks now. How can half the population contract it when put in this perspective? And for encouraging news, the death rate in the U.S. has declined to about 1.2% of cases as the testing of individuals in this country ramps, as we would expect. The bottom line is that we need to take a couple of weeks to see more data before jumping to worst-case fears that seem incredulous if we take this with any seriousness to lower the ramp curve. And internationally, it looks like there's some good news on that front. So our message at a high level remains the same. We've talked about this, several times with you, and we want to, restate. 1, if we take this virus seriously, we should get through it in a reasonable timeline, and not much longer than China and other Asian countries have been able to do. The economic pain will be deep, and this is point number 2, in Q2 and Q3 as we shut down our strong economy. But it should be short and swift if we manage this well. And I do want to emphasize again that we had a very strong economy going into this, and better to go in it on strength than on a flagging economy. To wit, today we had news that new housing starts totaled 765,000 new units in February. That's the strongest housing data that we've had since 2007. And I understand that's a little rear view in the mirror looking, but even in March, we're getting news that conversion rates, while traffic is down, conversion rates and buying, those that are looking, are converting at higher levels. So the economy, has been strong. The personal savings rate at 8% versus prior year averages in the kind of 2% range, and record levels of net worth and employment, all going into this will help us get through this. 3, we need policy support to build a bridge for Americans to get through the gap or the period of pain, and that's key. And we think it will be there. We've had significant Fed actions. They've shown that they're willing to do whatever it takes, which we think is very smart. And today, I think we're going to see good news in fiscal policy as well to help us get through this. And even folks like, Jim Cramer, who was just really shouting on CNBC back in 2007, 2008, they know nothing. They know nothing, speaking about policymakers, will admit and advocate that we're much more awake and smelling the coffee on these fronts as we attack coronavirus. 4, one of the keys for investors is to avoid whiplash, and that has really been our message in this. As downturns can be swift and they can be deep, we've seen it, we're seeing it now, but recoveries can be equally powerful and unanticipated. I'm not sure very many folks thought we might be up over 1,000 points going into today. We get a little news out of, good coronavirus data, better coronavirus data out of Italy and China, and we see Pelosi and the Republican Party, the GOP, starting to come together, and wow, you have quite a rally. I'm not saying that we've seen the bottom, but that shows you the whiplash that can be suffered if you act too swiftly. Now, the only nuance to these high-level comments above from observations over the last couple of days are the following. On the disappointing side, it looks like the U.S. Experience in fighting the virus may be a bit longer than that experienced in China, because we have been less aggressive in quarantine-like efforts. Yet, we're ramping on that, and we should not expect these horrible scenarios feared by many, such as 1 million Americans are going to die from this. On the positive side, the market does seem to be working hard to find that bottom, and U.S. companies with operations in China have reported that they are back online and gearing back up there. The CEO of Starbucks was talking today about the experience that they've learned through pushing through this in China, and how they're significantly getting back online in that country, and how that actually will help kind of maneuver things in the U.S. from that standpoint. So we're learning more every day as we work with this. Now, we're likely to see continued volatility and setbacks until the data in the U.S. indeed confirms we're getting our arms around coronavirus spread. In the meantime, I can tell you that we see U.S. stocks that are on sale, and the long-term investor should be served well to stay the course from here.
Yeah, no, thank you, Jeff. I think that was great, and I think it was helpful to address kind of what we're currently seeing. Our goal for today was just to potentially give you guys a sense of comfort in the term of sticking to the long-term plan and some of the stats we shared around the potential risk of losing out by not staying invested through these turbulent times, but then also gives you a feel for our current thoughts on the situation. So, Jeff, thank you for your comments today, and thank you all for tuning in.